Well, it looks like Santa Claus is not coming to Wall Street this year. We're having a December that I don't think I could compare it to December of 2018 yet, but it's pretty ugly. And if it wasn't bad enough that old Powell decided to go back on his promise to stop the stock market from ever going down even 5%, now Wall Street has to worry about West Virginia Senator Joe Manchin resisting America's urge to build back better. And Wall Street, they were looking forward to that, which is pretty ironic. Of course, politically, you wouldn't hear that normally. But it's true. Build back better would have been great for the stock market because the stock market has been craving more government spending. We need more, because the economy is not growing. The businesses are not growing. And so we need some kind of justification to rally in stocks. And if we're not building back better, and Powell is planning on tapering, turbocharging the taper, and then raising rates 3 times next year, that's a pretty grim prospect. At the same time, in the same week, we've had fiscal and monetary stimulus completely ripped away from Wall Street. And traders are not going to be happy about that. The algos do not like West Virginia Senator Joe Manchin. And I have to say, I love the guy. I mean, he's not good. I won't go that far. I won't say, like, he's a good senator. I just mean he's pissing people off so much. He's causing chaos. It's fun to watch. And he's doing it for obvious reasons. He's from just about the reddest state in America. So obviously he can't just act like he's going along with everything that Joe Biden wants when Joe Biden is extremely unpopular in his state. Joe Manchin has no illusions about being a national political figure. He's not going to be running for president anytime soon. He doesn't want to be nominated for vice president. He just wants to be able to survive in West Virginia. He wants to be able to win political offices there and remain powerful in that state. He wants to be the big fish in the small pond, in the pond with 5 electoral votes. And so, yeah, it's kind of in his best interest to throw a monkey wrench in Joe Biden's biggest legislative goal, in his trademark bill, the Build Back Better bill. But this news is breaking at an unfortunate time for Wall Street. I think that Joe Manchin could have softened the blow if he had waited until maybe, well, that's hard. I mean, markets reopen back up. There's really no good time for him to have said this. I mean, maybe after Christmas, in between Christmas and New Year's, maybe then people wouldn't notice it as much. But I mean, there's no way around this. The market would have to react to to $2 trillion in stimulus being withdrawn, because folks were kind of counting on that. Because as we learned over the past few years, the Fed is not quite enough. I mean, this market's been held up, probably 75% by Powell, but they needed that extra bump from the fiscal side, from all the massive government spending and the deficit spending, and the trillions and trillions and trillions of dollars in spending to pump these markets up. And so after, come Monday, today, when we already were seeing a lot of selling in the wake of the FOMC meeting and Powell's press conference, what is the long thesis now? Back in 2017, 2018, I remember, I was there, the long thesis was, well, tax cuts. Okay? Tax cuts are going to help the economy, and so these companies are going to be more profitable, and we should buy stocks. That was the thesis back then. Then Powell started raising rates because he said, you know what, hey, the market's doing so well, our economy's so strong after all these tax cuts, I can get away with raising rates. And then, until he found out that he couldn't do that. But no, Powell said, he reversed, he flip-flopped, he said, okay, I'll stop, I promise, I won't do it again. And he didn't. And things were okay for a little while. We stabilized. Everyone took Powell's word, and then things started to get bad because it wasn't enough, and so he had to cut. And then 2020 came, and things were really bad, and Powell had to cut all the way back down to 0. And we've been there. And then we started doing QE, because that wasn't enough. And so there has been no, there's been no real meat thrown to the bulls since the tax cuts, other than Powell and these stimulus bills. And so if Powell comes out and says, essentially, I'm going the other direction, I'm going to be Powell the Hawk, which, again, I think that's nonsense. He's going to flip-flop at some point. It's only a matter of time. But for now, he's Powell the Hawk. And West Virginia Senator Joe Manchin says, hey, that $2 trillion stimulus bill you guys were counting on? Ha-ha! I'm not going to do it. And so the long thesis has evaporated. And I can't see how we will sustain 200% market cap to GDP until Powell flip-flops and we get not just $2 trillion in more stimulus, but, 4, 5, 6 trillion. The NASDAQ today, at the lows, was down, I think, over 7%. I'm not exactly sure where it closed. I know it closed about the highs of the day, which I guess, maybe the bulls can take a breather for now. I was checked a technical guy's Twitter feed to see what he was saying, what he thought the chart was saying, and he was pointing at they seem to have staved off the worst for now. They bounced off of S&P bounced off some support today, and so I guess they can take a short-term technical breather. But fundamentally, something's got to give here. Joe Manchin's got to give in and sacrifice his career in West Virginia. 1. 2, Powell has to flip-flop. I think Powell's going to flip first, actually, before Joe Manchin. I think the politicians are much more trustworthy than Fed chairman. Because, politicians, they have clear incentives. If you've got an intelligent politician who knows what he's doing, you can look at the incentives and say, oh, okay, he knows what he's doing. He's going to make the decision that is, most politically profitable for him. But Powell doesn't have to answer to anybody. There is no outside forces which can influence Powell. That's the idea of, Fed independence. The only thing I should say that influences Powell from the outside are asset prices, because that's something he personally cares about. And so I think he's going to at least throw the market a bone when the S&P is down 10%. And you know what? Let me go check what the all-time high was on the S&P and see how far down we are right now. Okay, S&P only down 3%. That was hard to believe. With all this people that got their hair on fire, you would think that the sky is falling. S&P 500 is only down 3% from all-time highs, and that was just quick math. Maybe I picked the wrong date, but it looked like 47.12 was the all-time high, and we closed today 45.68. And so, yeah, under normal circumstances, in a real market, a 3% drop in an exchange-traded market is nothing. But we don't live in a market. This is not a market. This is a price that is targeted by the Fed. And the Fed doesn't let stuff like this go. And the reason why the price doesn't, on its own, ever fall 3% like this, really, anymore, is because it's been lulled into complacency by the Fed. Powell has been telling us since late 2018, or since early 2019, right? We're right around there, that essentially there are no more downsides. He has abolished market corrections. At least that's his goal. And so if you know that that's what the Fed's working towards and the Fed has your back, there's no real reason to sell or to go short or anything like that. Just buy and buy and buy more, and you'll make money. It's easy. There's no downside risk, so there's only upside potential. And so why not buy? But what Powell has done, and what Joe Manchin has exacerbated, is the reintroduction of downside risk into this market. They've changed that calculus. All the support here for the market was in the form of Fed and congressional stimulus, and both of those taken off the table. And so when you then look at the fundamentals, 200% market cap to GDP, and you say, hey, this manipulation is going away, or so we think as of right now. That's the official line is that's going away. How can you justify these valuations? You can't. GDP has not been growing. Why has the stock market been growing? The idea of the stock market is, you own these companies. And so as these companies grow and make more money and become more profitable, they become more valuable. And so stock prices go up. But when the underlying economy, which is made up of all these companies, is not growing, why are valuations growing? Back in 2008, when we had the big 2008 crash, market cap to GDP was something like 105%. Okay? About half of what it is now. Stocks are twice as expensive now as they were back in 08, 08. 07, 08, right around there, wherever the peak was. Twice as expensive. And you go back to 2000, which was the biggest stock market bubble in history. How expensive were stocks back then? 150% market cap to GDP. It's insane. You've never seen anything like that. Blah, 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 blah. Bigger than the 08 bubble in terms of stocks. Oh, that's right. We're 50%, above that. 50 points above that. We're at 200%. Where was where did stocks sort of stay for 15, 20 years before the dot-com bubble? Oh, yeah, it was like right around 50% market cap to GDP. Maybe that's a little low, but, if we crash down to like 80%, which would be reasonable, below 100%, there's a long way to go. We'd have to cut stocks more than in half. And look at all the gains in the time since, just since the Trump tax cuts, or since the initial euphoria from the Trump tax cuts. All the gains that we've had over the highs of 2018. All that was built by Powell and congressional stimulus. That's both Trump bailouts, Trump stimulus, and then the hope for Biden's Build Back Better agenda, which Wall Street was very excited about. All of this built the 200% market cap to GDP monster that we're all looking at now. I mean, 4,700 on the S&P. It was not that long ago that the S&P was struggling to break through 2,800. When S&P 3,000, that was a pipe dream. And yet here we are, when the economy now is worse off than it was back then. We've been through all of this economic pain. We've got inflation looking like it's going to get out of hand, although again, not totally confirmed. We don't know. I can't see 3 years down the road. I don't know how bad this bout of inflation will be in a historical, historically speaking, when we look back with in hindsight. But economic growth, it's been nowhere. And yet here we are. So look out below. There is going to be a strike price for both the Powell put and the Manchin put. The Powell put is going to have a much higher strike than the Manchin put. But they both have their price. If the stock market begins to crash in earnest, you won't see anybody in Washington resisting a stimulus bill. Joe Manchin will be the first one to sign his name to it. But before that, we're going to see Powell roll over. We're going to see the taper not only stopped, but probably reversed. We're going to see a restarting of QE. I still don't think we're going to see negative interest rates. I don't. Powell, for whatever reason, when Powell in the past has addressed that, I think that I do take him at his word that is not something that he's interested in. Because the results in other parts of the world have been so obviously disastrous and counterproductive that I don't think even Powell is going to push us in that direction. But he'll be happy to write a blank check to Congress to spend whatever money they think necessary to prop up Wall Street. So, with that said, I will see you folks back here tomorrow.